Every hour of every day, billions of dollars will move across the world. Banks will have created billions out of thin air. Government facilities will have printed millions more, and financial markets will have erased fortunes in an instant. Every second, the global money supply expands, not because of productivity or resources, but because central banks and financial institutions dictate its creation. Most of the money that exists today wasn't earned, saved, or even printed. It was simply typed into existence on a computer. It's not gold, it's not cash, and it's not something you can hold. In fact, over 90% of the world's wealth exists only as numbers, shifting between banks, corporations, and financial institutions. As more money floods the system, its value erodes, pushing prices higher and making everything more expensive. Meanwhile, the same system that expands wealth also locks millions into cycles of debt, ensuring that even as money is created, most people end up owing more than they ever receive. You'd be shocked at how many times the money in your account changed hands before it ever reached you, gaining interest for banks, inflating corporate profits, and creating debt before you even had a chance to spend it. To truly understand the financial world we live in today, we need to go back to the beginning. In the earliest human societies, trade was based purely on barter. A metal worker might craft a weapon and trade it for leather from a tanner, or a fisherman might offer his catch in exchange for firewood. But barter had a serious flaw. It required both parties to have exactly what the other needed at the same time. If a fisherman needed wheat, but the wheat farmer didn't need fish, the trade couldn't happen. This inefficiency made barter unreliable and slow, limiting economic growth. To solve this problem, early civilizations started using commonly accepted items as a medium of exchange. In different parts of the world, this took many forms. In regions rich in agriculture, dried grain became a standard form of money because it was durable, easy to divide, and had intrinsic value as food. In some places, people used livestock, salt, or even tea bricks. These early forms of money had no official backing, but they worked because enough people agreed they had value. However, these forms of money had their own problems. Grain could rot, salt could dissolve, and carrying livestock around was impractical. The need for a durable, portable, and universally accepted currency led to the rise of metal money. Around 3,000 years ago, societies in Mesopotamia, Egypt, China, and Lydia, which is modern-day Turkey, started shaping gold, silver, and copper into standardized pieces. These were among the first coins, and they quickly spread across the world because they solved many of the problems of barter. Metal was durable, easy to transport, and, most importantly, scarce. Since gold and silver were difficult to mine and refine, their supply was naturally limited, which helped them maintain value. As trade expanded across continents, coins became essential for commerce. Merchants could travel vast distances and exchange their coins anywhere, knowing they would be accepted. But as trade flourished, another problem emerged. Carrying large amounts of gold and silver was heavy and risky. Wealthy merchants, rulers, and traders needed a safer way to store and transport their money. This led to the first banking systems. Instead of carrying gold and silver everywhere, merchants in ancient China, India, and the Middle East started depositing their wealth with trusted businesses, temples, or goldsmiths who had secure vaults. In return, they received a written receipt that proved ownership of their gold. Over time, people began using these receipts directly in trade, rather than withdrawing the actual gold. This was the birth of paper money, money that had no intrinsic value itself, but was trusted because it could be exchanged for something valuable. But goldsmiths and early bankers realized that most people never came to collect their gold all at once. Since only a small fraction of the stored gold was ever withdrawn at a time, they started issuing more receipts than the actual gold they held. If a goldsmith had 1,000 gold coins in his vault, he could issue 2,000 paper notes and lend out the extra 1,000. As long as people trusted that they could redeem their notes for gold, this system worked. But the reality was that this new money wasn't backed by anything. It was created out of thin air. This was the invention of loans. Goldsmiths and early banks realized that by loaning out money and charging interest, they could make a profit. If a trader needed funds to buy goods, the bank could give him a loan in the form of paper money, which he would eventually have to repay with interest. Every time a new loan was issued, more money entered the system. Before, money was limited by the amount of gold or silver in circulation. Now, banks could expand the money supply simply by issuing loans. This allowed businesses to grow and economies to develop faster than ever before. But it also created a new risk. If too many people tried to withdraw their gold at the same time, the banks wouldn't have enough to cover all the claims, leading to financial crises. This happened multiple times throughout history. Governments eventually stepped in to regulate banking, but they didn't stop the practice of money creation. Instead, they formalized it. By the 19th and 20th centuries, most countries moved away from gold-backed currency and embraced fiat money. That is, money that has value simply because the government declares it legal tender. This shift gave banks even more power to create money, no longer restricted by gold reserves. Now let's replace the goldsmiths of the past with modern banks and their ledgers with digital numbers. And that's basically today's banking system. To understand modern banking, first understand this. The money in your bank account doesn't actually exist, not in the way you might think. The money in your account isn't cash. It's just a digital entry in the bank system, a promise that they owe you that amount whenever you decide to withdraw it. In reality, banks don't hold on to all the money they receive. Instead, they use it to issue loans, meaning most of the money that exists in the economy isn't created by the government. It's created by banks through lending. And it all works because of a system called fractional reserve banking. To understand this better, imagine an island town with 6 people: a fisherman, a baker, a carpenter, a doctor, a shopkeeper, and a banker. This town operates with a total of $600 in coins. The money simply moves around. The fisherman sells fish to the shopkeeper for $20, who then pays the baker for bread. The baker pays the carpenter to fix his oven, and the carpenter pays the doctor for medical treatment. Money circulates, allowing everyone to trade, but the total amount never changes. It's still just $600. Here's where the banker changes everything. The shopkeeper wants to expand his store but doesn't have enough cash. So he goes to the banker, who has a clever idea. Instead of giving him physical money, the banker writes down in a ledger that the shopkeeper has an extra $300 in his account. The shopkeeper is thrilled. He can now buy more goods, hire the carpenter to expand his store, and pay the fisherman for extra seafood to sell. The carpenter, now with extra money, goes to the doctor for a checkup. The doctor, in turn, buys more bread. Suddenly, there's $900 moving around in the town. Where did the extra $300 come from? It was created by the banker, not by printing new money, but by simply recording numbers in his ledger. And here's the key. This new money isn't free. The shopkeeper now owes the bank $300 plus interest. He must pay it back, which means he'll eventually need to take in more money than he spends. This is exactly how modern banking works. When you deposit money into your bank, they don't just let it sit there. They use it as a foundation to issue loans. If the bank holds on to only 10% of deposits as reserves, that means they can lend out the remaining 90%. If you deposit $1,000, the bank keeps $100 in reserve and lends out $900 to someone else. That person spends the money, and when it's deposited again, the cycle continues. This system creates a multiplier effect. Your initial deposit of $1,000 can turn into $9,000 or more circulating in the economy. The bank hasn't printed any money. It has simply created credit, which functions as money because people trust the bank will honor its promise to pay. Now let's flip the perspective. When you deposit your money to the bank is in debt to you. But when the bank lends you money, the situation reverses. You are in debt to the bank. A loan is just a digital promise in the other direction. You receive money that didn't exist before, but you're now obligated to return it, plus interest. Debt itself isn't necessarily bad. In fact, modern economies are built on it. Governments borrow to fund infrastructure. Businesses take loans to expand, and individuals use credit for homes, education, and everyday expenses. As long as the system remains stable and the economy continues growing, debt can fuel progress. But when debt piles up too fast, without the necessary productivity to support it, things start to go south. If too much money is introduced into an economy without a corresponding increase in goods and services, prices naturally rise. This means that the same amount of money buys less than it did before. In the early 1920s, Germany printed excessive amounts of money to pay off war debts. The result? Hyperinflation. Prices skyrocketed so fast that workers were paid twice a day just to buy essentials before their money became worthless. A major driver of inflation is how banks create money. When banks issue loans, they aren't handing out cash from their vaults. They're creating new money out of thin air. This fuels economic activity. But if too much lending happens at once, it floods the economy with new money, making everything more expensive. Governments also play a role. When they spend more than they collect in taxes, they borrow money by issuing bonds. Investors, banks, and even foreign governments buy these bonds, expecting repayment with interest. But when a government borrows excessively and central banks step in to print more money to cover these debts, inflation becomes inevitable. This is the balancing act central banks face. If they raise interest rates too much, borrowing becomes expensive and economic growth slows. If they keep rates too low for too long, inflation gets out of control. And then there's government debt. The US national debt, for example, is over $34 trillion and growing. To keep funding its spending, the government continuously issues bonds. But since it rarely pays off old debts, it must keep borrowing just to stay afloat. This cycle of borrowing, inflation, and central bank intervention is what keeps the global economy moving. It's a system that built modern civilization, but it's also a system that never stops expanding. Governments borrow endlessly, banks create money from thin air, and inflation quietly erodes the value of everything you own. As long as people believe in the system, it keeps running.